Welcome to Trade Ears, the Trader's Edge. I'm Jim Iuorio. That's Bobby Iaccino. We are also 2/3 along with Mike Arnold of unfilteredinvestor.com. Please check us out there. Thank you guys so much for tuning in every week. This is my favorite show to do. I love the live element, and I love the fact that you guys give so much input, and for that, we thank you. Bobby, crude oil. Apparently, it's been in all the news. Something's happening, this and that, and they're buying crude. Okay, so what's the risks now? Do you think the crude's huge jump, 35% since the beginning of the year?
Yeah.
They're pricing this in. Is there going to be a buy the rumor, sell the facts sort of thing? What do you think?
I think back to when Iraq was starting to lose their way in Kuwait, and they set the Kuwaiti oil fields on fire.
Ooh, I do remember.
Yeah, that's easily over 1 million barrels a day if that were to happen, and that is not easily recoverable. The Strait of Hormuz thing, they can get it opened up. That thing's been mined forever. It's just a matter of turning those mines toward the water. And the Navy, our Navy and Israel's Navy is now starting to clear those out. Bessent and Trump and Energy Secretary Christopher Wright said they're going to provide cover for those ships, and the U.S. is going to insure those ships, so you don't have to worry about insurance. Ships are still going in the other direction around the Cape of Good Hope. So you take an example like Germany, right? Germany doesn't have an energy supply problem. None of their flow comes through the strait, but they still have a price problem, right? So this has to get sorted. What I see right now is crude oil existing in a brand new price range, but I think the risk is still to the upside.
So you think perhaps if your take profit, you like me, someone who's been long crude, replace that with some call spreads to the upside for some volume moves, or just some calls to the upside? Probably that's
no cheap call spreads. I just think cheap call spreads, because it's not that I don't think it's likely. I don't see it happening that way, because there's, at least via reports, there's so many Iranians that wanted this to happen. It's not like, Saddam Hussein brought his army into another country and then on his way out, he decided to burn the whole thing down. This is a little bit different, but it could happen. So that's what I'm most weary of.
Yeah. And again, remember we were talking on Monday on our other show, and I was like, oh, this looks like the top. And then boom, Straits of Hormuz get closed and it rallies another 8%. So again, when you think it's over, it doesn't have to be over. Anyway, we are going to bring in our guest. John Love is the CEO of USCF, which is the firm behind some of the largest commodity ETFs in the US, including USO. It was no accident we were talking about oil there. So let's bring in John Love. John, the first question, this is important, and it's somewhat on a serious note. Do you think the name John Love, back when you were in high school or college, gave you a leg up with women just because it subconsciously throws the love thing in there? Do you think it was an advantage or a disadvantage?
It probably was an advantage, but I wasn't smart enough to realize it, because as in elementary school, your last name's Love. Everybody's making fun of you. John Love, who do you love? So it's horrible. So you go into high school and people are singing songs and you're like, oh, wait a minute. Now this is, a little affectionate. So I think I maybe missed it a little bit, but long story short, it was helpful. My wife
said they call me Dr. Love over and over and over again. That would have been the one I picked.
Yeah, I would have fumbled that ball too. I could have been given I could have been 6'4" instead of 5'8" and still would have fumbled every advantage I had with women. So I would have
still going 5'8".
Yeah. Yeah, I'm still going 5'8". Anyway, John, how are you? Thank you for coming. Where are you coming to us from right now?
I'm in Redondo Beach, California. It's a suburb of LA, just south of LAX.
Sure, I've been there. And are you from there?
I'm not. I've been here since 1989. I came out for college, but I grew up in the Chicago area.
Oh, where about?
Schaumburg.
Oh, yeah. So I'm in the Keys right now, but I live in Palatine and have a restaurant in Palatine as well. So we were neighbors. That's funny. It's a small world, isn't it? And Bobby's got a lot of family in Prospect Heights, or Mount Prospect. What's the name of the town? Prospect Heights or Mount Prospect, whatever. You know what I'm talking about.
Mount Prospect and Arlington Heights.
Yeah, fantastic. That's
so
awesome.
We're all warmer now. That's good.
I'm in Marathon right now, and it's about 80 and sunny out. As soon as we finish here, my wife's sitting in the backyard with the paddle boards in the canal, and we're going to shoot out for sunset with some friends on the paddle board. So I'm enjoying warm weather right now. You heard us talking about oil before. So have you, is the USO graduated to a point where the world jumps on that as a knee jerk over futures? Where does it fit in the world of how important is it in times of crisis?
I think people, it's kind of a benchmark you see in the news a lot. People look at it. I'm even, it's been out almost 20 years. It'll be 20 years old in April. And even to this day, sometimes I'm surprised when I see USO in the news instead of, prompt future or something like that. But, and that's nice. In terms of, its importance, it was designed and it's still used, I think, the same way. I mean, 20 years ago, it was very hard for a lot of people to get into futures. Today, it's easier, but there's still that, that challenge. If you're investing in futures, so it's probably not a lot of your audience, but a lot of people don't want to deal with the leverage margin calls. They don't want to deal with rolling the futures. This sort of does it for you. So it was an access product when we came out with it. I think it still is. Interestingly, a lot of institutional investors tend to use it, even though they could use futures. So I think it's just the convenience of it. It's extremely well known, very popular ticker. So that's kind of how it fits in.
So depending on the shape of the curve, is there a cost that's baked into it because it's built on futures, correct, John?
Correct. Exactly.
So you have to roll futures, and you could be rolling into more expensive contracts, so that it kind of almost comes out as a decay element to it. Is that correct?
If you're in contango, yes. So, the first, most of the first 15 years it was out, contango was the primary state of the market. So there was a contango decay, but then the roll yield turned positive since COVID. And so I used to get questions, why is USO underperforming or, underperforming what I think I should get from an oil return, not realizing that, if you bought a futures contract and rolled it, about the same time we did, you would have the same economic result. It's just people didn't get that because you look at the headline price that's based on the prompt future and, it's $50 today. It's $75 at the end of the year. That's the return you think you should have gotten, when in fact there might have been, there's a roll yield, positive or negative. Last 5 years has been a different story because there's been we've been in backwardation. And so I actually had somebody just yesterday saying, hey, how come you're outperforming? And we're like, hey, love to explain this and how it occurs and all of that and go into detail, but it's a lot nicer when it's an upward slope. When it's a downward slope, that's for sure.
John, what do you think the situations are where one would choose the other? As you mentioned, when USO came out and until really post-pandemic, the market, the shape of the curve wasn't in your favor. And there was a lot of talk about why would anybody be in USO when you consider the way the futures are trading. Now, if you look at a USO chart, there's gaps all over the place, and that's the nature of crude oil futures. They move a lot overnight, and therefore USO gaps. And you knew this question was coming, right? So why would somebody choose UFO? Is it just convenience because they don't have a futures account? I know you talked about not wanting to deal with margin and things like that. It is obviously priced nearly the same as crude oil. And you're talking about Reg T margin with an ETF versus, now that they have the micro contracts. Yeah. Why do you think someone would choose it? Is it all convenience?
No, I don't think entirely. I think it is certainly the convenience is there. Again, there's a lot of futures I can't trade like oil because of what we do, but I do have some index futures just on, S&P 500, things like that. And I'll use that. And I always think to myself, I get sick, I'm in the hospital. If a contract expires, my wife has no idea what's in there or what to do with it. So I think, there's that. There's also, if you know how to use leverage and you're smart with leverage, even with the micros, then, I think, that's, you're probably on the safe side trading futures, but a lot of people get themselves in trouble with leverage. So this eliminates that. And it does eliminate, in a normal market, when you have, say tamped down volatility, maybe you see a couple $1,000s going back and forth each day on your futures position. But when you get in something severe happening, something drops in your long, something shoots up in your short, and suddenly it's tens of thousands of dollars. Do you have that cash position? Do you have to sell something in order to raise that cash to meet that call? So I think, just people, even if they know what they're doing, but don't want to deal with that, I think it's helpful. If you want that, 5, 6, 7 times leverage that you get with a futures contract and you know what you're doing, then, I think the futures make sense. And your question on gapping, was that you mean the time like between when USO closes and the future? Yeah. So yeah, that confuses people sometimes, but I mean, really what happens is you reset the next day. So you are tracking what, the same economic result of the future, but there is that period of time where the NAV will settle to the 230 New York settle price, and the electronic contract is still trading. So yes, you do get that gap.
Bobby,
I
can
can
I ask you a
actually
quick
show
question?
you exactly what I mean, Jimmy, if you don't
Sure.
mind. Luis, if you can put this chart up.
Yeah.
If you look, there's, especially over the last few days, this is a USO chart, and you could see that there was sort of a positive finish, but a flat versus the previous day here on USO. I should zoom in on that, shouldn't I?
Yep.
So this is the couple of days approaching the attack in Iran. So here's USO, right? Here's the 25th. You had a big downdraft and then a quick close near unchanged. But if I switch this to a crude oil for the 25th, you actually saw, this is crude oil futures. Here's the 25th is really the course of these 2 or 3 days. And then you had this rally and then the snap. When you look at the actual move, it was like 11.8% versus 12.4%. So that's kind of what you meant, right? It basically comes out in the wash either way.
Yeah, exactly. So you just, when it opens on Monday morning, now Sunday when the future was trading and reacting to what's going on in Iran, obviously, USO is still stuck to its Friday price, but it's going to move to wherever the future is at the equity market in NYSE open on Monday morning.
Bobby, can I ask you a question real quick?
Yeah.
Do you think the Trump administration, what percentage possibility that the Trump administration launches a market moving initiative, whatever it is, when the markets are closed? Is that a purposeful thing that he does so as to let people digest it before the market's open? Do you think it is
100%?
John, do you agree with that? That's why he does that? Because that's what I thought the first thing when I saw the headline.
That is exactly what I thought. And sorry, I know he asked you, Bobby, but since he pivoted to me, I'll just real quick. I mean, yeah, that is exactly what I thought. Wasn't surprised at all Saturday. I wasn't necessarily expecting it, but I wasn't surprised. And I think that is helpful because it's kind of remarkable that the volatility isn't higher than it is given the scale of what's occurred. We could talk more about that, but
No. And I think so. A lot of people say, well, he's just concerned about markets, but I think it's a defensible tactic to try to avoid any large scale disruptions in financial markets or commodity markets. So I can defend it pretty easily. You guys both agree with that, George? John, you first?
To a degree. I mean, I wouldn't want to make policy based on it. There's definitely this, there's been mixed signals about why they did it, when they did it. And, if you accept one of the narratives they put forward, it seems like it was opportunistic, or, they kind of, one side, Israel or the US, one of them, had to go along with the other. Who knows who's telling the truth there? Right. But at the same time, you do go, well, but it happened on, Saturday when the markets closed. So, does that mean that these things just lined up perfectly, or was that part of it? But it has happened more than once. This is not the first, obviously Venezuela, this and many other times through both Trump administrations.
Right.
Yeah, it is 100% my view that that's part of the calculus. It's part of the conversation.
Sure.
Well, we can't do this on a Wednesday, and next Friday we have non-farm payrolls, so we better do it before then. To me, it is 100% a part of the calculation. When they talk about, well, Israel was going to go, so the U.S. decided to go too, and then Trump says, well, we were going to go, and Israel said we can go now. So we said, I think certain parts of that conversation are silly. Trump listed out a deadline. I think he went before the deadline was over, but they were definitely sending signals. The U.S. side was sending signals that the talks were going nowhere. And we've had red lines drawn before. And by the way, I'm not saying I'm for this or against this. I'm just saying that we've had red lines before. And I think if nobody was paying attention to Venezuela, I think they're a little silly to think that Trump wouldn't adhere to his red line. And some people are going to hear that and say, yeah, because he's nuts. And other people are going to hear that and say, yeah, because he's an American patriot. I don't care about that stuff in the context of this conversation. You know, by the way, Jimmy, there was a person saying you were afraid to offend people.
I thought that was funny.
Yeah. So I think it's definitely part of the calculus to your original question, Jim. I literally think they're sitting in there going, well, how's this Friday or how's next Friday? I don't think Israel might have said, we're going on Thursday. And, whoa, we can't. We got to give the markets time to calm down. You know, I don't know. I mean, I don't want to go too deep into this.
No, I know. Well, let's switch it from oil real quick, because I was on your guys' webpage today, and there's so many interesting products that you have. And in the Trader rundown, we were talking about some alternative energy products. You've launched recently some alternative energy products as well too. Can you go into which one? Pick one out that you think is a favorite, and you think is going to be a can't miss, and tell me about it, will you?
Sure. Well, we've got one. We've got a copper ETF, and that's what people have gravitated towards. So I know you said one, but
no, go as much as you want. You're the guest.
Yeah, copper's drawn. I mean, copper's is getting close to the size of USO, and we always thought that would be the case. And we can talk about copper plenty. We also launched two alternative energy products, like you mentioned. Tickers are ZSB and ZSC, and basically one of them is battery metals, electrification metals. So it's got lithium futures, it's got cobalt futures, and then the usual stuff: copper, nickel, aluminum, all of that. And
what's the ticker for this? Because I've been wanting to increase my lithium exposure, and I did buy SG. Is SGML? Is that something? If you guys know, somebody gave me a stock that was lithium. But tell me, what's the ticker on that one?
ZSB is the ticker on that one.
ZSB. Bobby, any way we can do a little technical analysis on that one?
ZS or ZF?
ZS. Zebra Sam.
Yeah, I mean, I'll put it up. It's not high.
You keep talking, John. By the way, twice I've wanted to call you Jordan Love, and it's not that I'm a fan. I hate the Packers so badly. Are you a football fan, John, or no?
Yeah, not since I moved out here. Probably back in, when I was in Chicago. But
because it was crappy weather in the fall and you needed something to do.
Right.
Where you are now, you have other things to do. Right?
That's right. And it was showbiz out here. A little less. You had your Raiders fans, but yeah, it's not quite the same.
Okay.
So.
And where'd you go to school? You said you went to
SC, USC.
Oh, very cool.
Oh yeah, I should have been into football more than I am, but
right, exactly. Yeah. So Bobby, what does the chart look like? Because I'm interested in this very much. I'd like to get more exposure to this sort of thing.
That's it.
That's it. So we need to take out that recent top around 23 and a 2330, 2340, you think, to get those moving averages moving in our way?
Yeah, I'm gonna just measure something out while you guys are talking, but it looks like let me just do.
Because anyway, John, we were talking about how this power thing, we're going to need twice as much power in 10 years. So even if you don't necessarily believe in the sustainable energy move, you have to understand that it could be all hands on deck as far as where we look for our power. Is that fair and reasonable?
Yeah, absolutely. I mean, we launched this thing in, I think it was 22. And, so everything was, Biden administration, renewable energy. That's not the reason we launched it. That is the way the world is going. Politics doesn't matter. I don't think oil is going to drop off as rapidly as some people think. I think we do need, just like you said, we need power from everywhere.
Yeah, right.
And that was before the AI story. And then you bring the AI story into it, and we do need everything. So I think it's kind of silly when you have, I'm all for clean air and all of that, but when you need energy and you're shooting yourself in the foot and saying we're not going to build this kind of thing with the Biden administration, then you come with the Trump administration. All right, we're doing the opposite. We're not going to build this or that. It's all going to be needed. Things come in and out of favor based on the zeitgeist, but ultimately the prices are going to be based on supply and demand, and that demand is there and growing. So. We launched, actually, it was interesting, lithium prices had run up, just dramatically prior to that launch. And then, it actually came down significantly right after we launched this fund, but they've been going up over, the last year, this year. So lithium's one of the, stronger commodities right now. And I think that's true of, the other electrification metals, maybe, one or the other is going to be on top at any given time. And I think they're all
makes sense.
They're all going to be important over the
John, let me understand this. This is not all lithium, correct?
No. Correct.
Okay. What's sort of the breakdown? We always hear people talk about the dollar index, which Jim and I always say that's basically the dollar against the euro. So what's like the breakdown of this? You don't have to give me exact percentages, but just kind of in order.
Dang. Lithium and cobalt, I believe, are the two biggest holdings. I could pull that up I think it's on our website, but to be honest, I've been looking oil so much over the last couple of days.
Oh, that makes sense.
I will tell you that it's lithium and cobalt are higher allocations. The methodology, basically once a year we rebalance, and we're basing it on how important is each metal on a relative basis to the electrification economy. So if, batteries and power stations and all of this, it's 25% lithium, then 25% lithium would be that weight. I don't recall off the top of my head the exact last reannouncements, but that's the idea.
What does sustainable rare earths look like? Because we obviously have a situation where China still dominates it, although when we're holding their oil hostage, I don't know, they may bend on that a little bit. Go ahead. Yeah,
the sustainable in that was more towards the environmental side of it, but the precious, those particular metals are, you can't get access to all of those through futures contracts. We did have at one point an equity sleeve, and we could do that again in the future, where we get exposure to miners in metals that I can't even pronounce and won't try.
Molybdenum. I've been working on it. Molybdenum. Sorry.
I was at a conference, by the way. Somebody was coming around with a rare earth, the coolest looking rock you've ever seen. I wanted somebody to start a physical ETF based on this, and never heard of it. It's not in our battery metals fund. It's not something that I've seen miners on, but there's some interesting stuff out there. But anyway, getting access to that is a challenge. But that's one way you can do it is look at the miners for those particular rare earths.
Bobby?
So what else do you have going on that's already sort of established? We know about USO, but what's like your next most established ETF in the commodity space? I think we're talking to you in a very timely time. Does that make sense?
Yeah, it doesn't make sense. But anyway, we get it. Is it UNG?
It has historically been UNG. Copper is now bigger than UNG. So I would say, between those two, and it's going to vary. UNG can shoot up when there's something exciting going on, but it's copper.
What's the symbol on that?
CPER.
Oh, I know that one actually.
That was an interesting one last summer because, again, you look at the function is very similar to USO, by the way, but it actually is a little different. It's not just front month. It has some contango mitigation built into it. So there's an index, and it'll basically, if the market's in contango, it'll own 3 futures. If it's in backwardation, it'll concentrate towards the front. So that mitigates that a little bit. And we've done, that contango mitigation with a couple other products. But what I was about to say is, copper was really interesting last summer because first of all, you had the tariff situation starting from, pretty much when Trump was inaugurated. That started to get priced in. You had this premium open up CME futures over equities. And in early July, he said he was, basically going to tariff copper. So you had this premium shoot up, and then he changed his mind and said, no, it's going to be on copper finished products, not copper itself. So you had copper plunge, which at that time we actually published a little piece and said, this might be a good entry point because, you've had this market, running up like crazy, and all the fundamentals are still there. You just basically erase this premium, and that is how it played out for the rest of the year.
This is an interesting move when you see a move like this get reversed the way that it did, and then it just grinds up over a period of time and makes a new high.
Yeah. And by the way, when it made a new high, then it flirted at that new high, created a base. I think this chart looks pretty good. I mean, some parameters need to be met, but I think that everybody is sleeping on the copper story. We just have been talking about energy. We are in a copper deficit. Chile doesn't, and correct me if I'm wrong on this, the environmentalists have gained some foothold there as well. And it's not like they can just expand copper production like they were able to do 20, 30 years ago. I think copper is a huge story. What do you think on that, John?
Oh, yeah, I absolutely agree. It takes, 10 to 15 years to bring a new mine online, and it's just not happening. And there's been we've been banging this drum for a long time, for especially over the last 5 years, but it's finally built up and started to solidify. The one thing you do have with copper, and I think you're kind of seeing that, is there's this sort of market that's right now there's some worries about and with the oil story, we're going to have a slowdown, and copper is tied, it's more correlated with the economy, the global economy, than something like softs or ags, which can do their own thing. But at the same time, then you've got this supply story, and the supply is not going to be met. And constantly we're hearing we need more supply. And you can put data centers in space, but you still need copper. So there really hasn't been a solution put forth. I know the administration was doing something, maybe opening up a little mining possibilities in the U.S., but that again takes a long time to come online. And our copper is not as easily available as it is in other countries. So
can we take a quick time out? Luis, will you put up the banner? This is halfway through the show. This is where I ask you, listeners and watchers, who we so appreciate your support on this, to do us a favor, and that's to try Tradier Pro. You get 3 months for free. Just scan that QR code right there. We talked to option traders who've been trading for decades, and those who've been trading for days, and they all say the same thing about Tradier Pro, that it is top-notch. It is the gold standard in options trading platforms. So as a favor to us, or if you're genuinely interested in the best platform out there, scan that QR code, try it for 3 months for free. Thank you. And now back to the show. That's how professional we are, John. We're like real live journalists. We can bounce back and forth. It was beautiful, wasn't it?
You sold me. I almost took the QR code, but I'll get it later.
Okay, good. See, that's what I'm talking about. Okay, but continue on, please. Yeah.
Oh yeah, no, I was finishing up that thought. Just that you're exactly right. I mean, I don't see a solution to this copper deficit. Now, what we tell people is, you do have to be cognizant. There could be a bit of a downturn if there is a recession or something like that. And if this oil story, if this goes on, we'll see how that impacts global markets. But it looks like right now, I think the market's still pricing in short duration for this Iran situation.
A quick follow-up question is that we always, as traders, we always associated with copper prices with China. To me, it seems like that relationship has lessened a little bit, and now copper is more about the global economy more than is China. Is that my imagination, or do you believe that's true, John?
I think it's certainly expanded. I mean, South America was always important, but that's probably become more significant relative to where it was. But I mean, China does remain a big player. They have a lot of copper. There is, I would like relationships with China to be good, so we don't have a copper shortage. Put it that way. That would be ideal.
I'm wondering, as we talk about copper, if either one of you, and I'll go to John first, if either one of you have an opinion on exactly what happens. How do we get in a situation where people think we're going to get to the point where we don't need copper, and these mine projects and everything else just kind of get put on the back burner? Is it the sort of short-lived nature of politics that happens here, where somebody goes, well, I'm only going to be in office 3 terms, so I'm not going to worry about it? Or I don't understand how we get to the point where our grid gets so old. John, do you have, I mean, obviously this is not market related, but do you have any idea as to how we get ourselves in this situation? Because I'm telling you, I think copper prices are going to triple at some point.
Yeah. I think it's, yes. I mean, part of it is what you just said. I mean, politicians only on office so long. Same thing with the debt situation. We just keep kicking it down the road because nobody wants to be the one to deal with it. But there was, and there still is, I mean, a huge resistance to mining, energy production, all of that. And so depending on who's in power and who has the upper hand at any given moment, I mean, projects get restricted. So you probably have, prices of a lot of commodities a lot higher than they necessarily would have to be right now if we had taken action 10 years ago, 5 years ago. And yeah, I agree. It's just not happening. And you can see those supply and demand stories all over the world. Here in California, with oil, I mean, why is oil $7 a pump when it's $4 everywhere else? Is a few years ago, and Why is it always $1.50 more or whatever it is? And it's, well, we've closed up our supply. We don't have pipelines to get it, so we've got to bring it in the most expensive way possible. We're closing our refineries. Same thing with copper. If you're not keeping up with that demand and you're not, I mean, everybody wants to protect the environment, but at the same time, we want our iPhones, we want our EVs, we want our old fashioned stuff, and we want our stuff that's going to enhance the environment. All of that demands that we, pull these metals out of the ground. And that includes lithium, which is not, a clean operation. It takes tons of water. It does, tons of pollution. You are, stripping the earth. But, if we want to continue to be a civilization, that a modern civilization, we have to have some way to keep up with the demand for what we're producing.
Can we pivot to your gold? You have an ETF that's a gold income strategy fund. So I've been talking, Bobby and I, by the way, for our background, we've been positive on gold for 5-6 years. For the first 4 of those years, people called us crazy conspiracy gold bug, tinfoil wearing hat people. We still have the same fundamental thesis on gold. Now we don't care that they call us those anymore, and they don't, because we've been right about it. The income part of it, I've always, oftentimes I sell call spreads against my gold positions. Is that what that ETF does, or does it go to miners that pay dividends?
No, it actually sells not even call spreads, just outright calls. So it's just your classic, own gold futures. We will take delivery of warrants. So essentially that's the same as warehouse receipts in a GLD type product. So you can have warrants, futures, and then we're selling the calls. And the idea with that is, how it pays off. I mean, most of the time, calls are add income, and they do add income in a parabolic market or a really strong market like we've had. It's going to go against you because the options positions will not, are going to work against you at certain times. But the idea with it is we think gold is probably, I think there's enough people that believe gold should be a permanent allocation. I want to hold it as a permanent allocation at this stage in my life. Maybe you want it for your entire life, but we do know that gold has these cycles where, it's done great over the last 3 years. And this last year, especially, we also know there's periods where, 2011, 12 to 2020 or so, it did nothing. And, late 80s, 90s. So, the idea here is that you have that allocation to gold, but in down markets, flat markets, even, fairly decent, progressing up markets, you're earning an income stream on top of it, because gold just, otherwise it doesn't pay anything. So,
but you're capped. So you'd like, if you were recommending, and I know it's not your job to recommend necessarily, or maybe it is, but you'd say this is your gold exposure. If you're planning for the Armageddon scenario, your gold fund should just be part of your gold exposure, the part that gains income. And that if some other naked longs, that in case gold gaps up 20% in a day, you're still covered, correct?
Yeah, I think if you are a person who's thinking, is like, hey, gold's going to rocket up, then yeah, I think some of the GLD or the future or whatever, just outright futures is going to be more your game for that short term, or whatever you think that cycle is. But if you're saying, hey, I think gold is toppy, I think, maybe it, keeps going from here, but maybe at a slower pace, or even, I think we've had our run, then this might be where it fits in. Or you want that gold allocation, but you do want it to produce some income for you, which is what people were kind of asking for, which is the reason we launched it.
I like it.
I want gold, but I want an income stream from it.
Right. Yeah. Bobby?
So I obviously got dropped. I dropped out of the show.
It was my dream to have you not bugging me in the show, just let me talk. So,
dude, I'm in your life now. That's it. You can't get rid of me. You can't quit me. Just if you could just explain again how the income works to where it softens the blows on the down moves of this ETF, or does it pay a dividend?
It pays a dividend. So yeah, you'd have to look at total return in terms of it softening, the blows. But if you look at total return, factor in that dividend, then it would do that.
Gotcha. So where do you look for volume on an ETF to be? I guess I'm asking 2 questions here. Number one, do you ever say, okay, the ETF didn't work, we're going to delist it? Or where do you look for these kinds of things to be in order to say, okay, this is a successful one. We're going to keep backing it up with all our technology and everything else we do.
Yeah. So, volume contributes to it, but it's really the asset level that is the long-term driver. We have a history. We have closed funds before. It's very, it's different. There's not like hey, this fund is only X size and it's been this many years, let's just close it. It really kind of depends on what does it look like right now. So if we've launched something and it's 6 months later and we're like, wow, we just misfired on that one and we don't see a future here, we could close something. If we had a fund that, and most of the things we launch, we don't launch because we think they're going to be duds. We think there's a market for them. We've supported our products over a long period of time because it takes time to catch on. Depending on the product, it may depend on the market cycle. So we've got things there where, we're not saying, USO, it's an access product, right? So if I launch a product like that, we've got a lithium standalone product in registration, something like that. It may catch on quickly. It may catch on after a while. We file these things and launch these things because, we believe in them. So, but, the criteria is not so much volume based. Low volume is not going to be helping us. But the idea is, let's get enough people in there and trading it where the AUM is at a self-sustaining level. So, most issuers, I think, your break even probably could be as low as 30 million or, it can be as high as 100 million. Probably gets interesting around 100 million, but we'll launch products and we'll support them for a long period of time if we think that, there's demand that's going to materialize.
Is every one of your ETFs have a commodity bent to it?
Not every single one. We have with a sub-advisor, Miller Howard, we have a midstream energy product, MLP product. We also have with them a dividend income product. Everything else right now has a commodity bent. That's been our bread and butter. We have done some things off the beaten path, and like a lot of people, we're looking at always looking for the next thing. So we've tried some things out, but we've stuck pretty close to commodities so far.
Bobby, should I send him the paper I wrote on the Boomer portfolio?
Yeah, for sure.
Because I think that there is this thirst, and tell me if I'm crazy. I think there's this thirst for. I'm turning 61. Most of my friends are older than I am. I've kind of come up with a strategy that I manage my own money, and that is like has a 40% allocation to equity split between S&Ps and QQQ. But 10% of that is a heavy call selling strategy. 10% of the amount, so a quarter of the equity portfolio, and then the others has kind of a dynamic put strategy that takes advantage of theta by buying longer term puts and selling shorter term, and then rolling them at a set date. And then the rest of the four components of the rest of the 60% are set up: real estate through ETFs, gold, silver, tiny bit crypto through ETFs, long term bonds, and then 2-3 month bills. And I'm doing lots of back testing, and it's hard to back test the options part of it, but it seems to be like a 8.5-9% return, but the max drawdown would be like 12% in a 2008 scenario. Do you think there's a thirst for something like that?
Well, I hate to tell you, this is not the first time I've heard somebody mention a Boomer portfolio. So yes, I think you're onto something. Now that particular strategy, I don't remember, but I've heard somebody pitch that. Maybe we bumped into each other somewhere, and it was you. So.
Could have been. I think this is the beginning of a wonderful friendship. You're going to launch my ETF. We're going to make fortunes. Bobby?
I'm just looking, and there's some breaking news that the Iraqi Kurds have launched an offensive into Iran. So,
wow.
Yeah, this is becoming a whole thing. Now, right now, I'm not seeing crude futures move. I wouldn't expect that they would.
What about equities? Oh, we're closed. The futures are closed. Right?
Yeah, they're closed, so they're not moving. Equity futures and Nasdaq still kind of ticking up, but not much. Which I don't know why anyone would tick up on this. I mean, to me, you got to see crude oil come down, because at some point it's going to start bleeding into CPI, and it's also going to start bleeding into the earnings of any company that has a heavy energy footprint, regardless of who it is. whether it's an electronics company or an industry or anything, it's going to start bleeding in. So this has to be short-lived. And unfortunately, I don't think we have enough in the strategic oil reserve to release enough to ease prices. And that was one of the problems I had. And you guys can both chime in on this with the Biden administration's release, just because prices were too high.
Yeah.
This, to me, even though the U.S. and Israel jumped to the attack, this is exactly why you have the strategic oil reserve, because at least you could, I don't want to say manipulate, that's not the right, affect WTI prices, in which there'll be a lot of prices like crude oil in Canada, for example. There's something in the oil world called pipe plus, right? And in Canada, it's actually pipe minus WTI. So there's a discount on Canadian crude because the buyer has to pay the transport price, and the transport price is prohibitive from Canada with Canadian oil sands. So when you look at it from that perspective, that to me is what you control, at least a certain type of crude oil's price with the strategic oil reserve. And there's not enough in there.
Bobby, but you okay? So you didn't use the word manipulate, Bobby. So John, to Bobby's point, we like to call ourselves not political, but we comment on every policy. We don't care who authored that.
Yeah, we don't care.
Mm-hmm. Selling the strategic oil reserve, which was 6 months before an election, when the only emergency were that prices were reflecting badly on you, was an atrocious thing to do. In my point, again, not refilling it at $54 a barrel, or when Trump was in office, I think that was egregious as well. Do you have any comments on any of that, John, or do you not like to wade into that kind of stuff?
No, I absolutely agree with that. I think, yeah, it was absolutely a political move. I think it should only be used for, strategic need. I do think Trump will probably potentially use it, in the same way if prices get too high. Although, as Bobby said, there's, not that much, that it's going to move the needle. I will say it, even though Biden did sell it off or, draw it down, it had been at all-time highs. I think, that's a good thing to have when you've got uncertainty in the world, especially when you're challenging people and doing the kind of things that we're doing right now. But nevertheless, where it is right now is sort of like the middle average level that it's been over the last 10 years. So I think maybe there is a little political cover for not refilling it. I've seen that, a lot of people saying you should have refilled it. And that does I agree, you should have refilled it. But I think they maybe are saying, well, it's not like as low as it was, 11 years ago or whatever. And but yeah, based on the population, the growth in oil, the fact that, a counter argument actually is we're producing so much now, there's less importance on the SPR than there was, 10, 20 years, definitely 20 years ago. So that is the one thing.
I'm not trying to disagree with you, John. I just want to clarify something. Oil's not fungible. People think it is. You need to have trade, and that's not a commentary on Biden or Trump or either one, because you can get some of the heavy crude from Mexico, you can get some of the medium crude from Canada, some from Venezuela, and the U.S. crude is very light crude. So there needs to be trade we're not energy independent. No one is, because there's so many different levels of crude oil, and the energy independence comes from being able to swap one for the other. Right. So I just want to throw that out there to people.
Yeah, I don't disagree with you. I just think it's different than it was. It's a better situation than it was. Mm-hmm. We do have more, but that's absolutely right. We produce 13.8 million barrels a day. We use 19. So those barrels are coming from somewhere else. And that's before you even talk about the different grades. So yeah, right. Good point.
Hi, Bobby. John, I have a question for you. Let's say you launch a fund. Let's say you launch the USO fund, and whoever the launcher is of the fund, when the option market launches, is that something that the market does on its own, or is the launcher of the ETF involved with the options market as well? How does that even work? I don't know.
Yeah, we're not involved at all. It just will, if an ETF gets liquid enough, then market makers will list options on SIBO or wherever, and it takes off from there. So it can actually be a surprise. Now we can talk to market makers and say, hey, this is out there, and
sure,
maybe take a look, but it's really going to be up to people that want to actually list those options. So we're really not involved.
And how many of your ETFs have options markets on them? Most of them?
Not the small ones. So anything like what you were looking at was ESB, that's still in let's say a startup phase. So that doesn't have it. So healthy on USO, UNG, copper are broad commodity ETFs, SDCI, USCI, anything gasoline. I think anything that's or has been over 100 million is going to have options, probably over 50 million. But yeah, not everything, not the funds that are, still sort of in their incubator stage.
Makes sense. Bobby, you got a last question?
Yeah. What's the gasoline ETF, John?
UGA.
Oh yeah, I know that one. Right. Yeah.
Yeah. There you go.
Want to take a look at it real quick?
Yeah. I want to put this up on the screen because this interests me because as you know, there's a lot of situations like in the future side, we trade the crack spread, but the actual trading of pure gasoline, I rarely, if ever, do that, and this actually interests me a lot. From this perspective, you're seeing gas basically on an upward trajectory going all the way back to June of 2026. And that's difficult to do when you're looking at
2025, you mean?
Yeah. I'm sorry, 2025. And, you're looking at what's the contract? I'm thinking the futures contract.
RBOB.
Yeah, RBOB. It's not as clean as this, if you ask me. So this is super interesting to me.
So tell me this, when you guys look at that chart, does that mean a wipeout in the midterms, in your opinion, John? I'm being serious.
Yeah. Well, if it doesn't come back down, yeah, it'll contribute. It'll certainly contribute to it.
It seems. Bobby, what do you think? Does that look like a wipeout to you?
Yeah, I mean, this is not the price of gas. This is the price of the ETF, obviously. But again, I think the wipeout is this attack of Iran if it's not short. I really do.
Yeah.
It needs to be short.
They're all the same thing, right? This chart, the attack of Iran, it's all the same thing, right? Interesting.
But again, here, this is what I was talking about. I had the wrong chart up. I still had the crude oil chart up. If you look here, this is January of 2006. Okay, and this is gasoline according to this ETF. Yeah. Right, which I know John well enough now to believe him that it matches gasoline prices. So this is gasoline. Okay, there is no, Trump talks about gasoline being at $1 something. That's a Trumpism to me.
That's a Trump. That's a Trump thing.
Gasoline literally be like, I saw it as low as 14 cents.
Right.
He just does that. But
to be clear on that one, that's
uptrend here according to this ETF. Go ahead, John.
That's RBOB futures. So, it's not the price at the pump that it's reflecting. So that's downstream, but it's, indicative of where, it can go. So.
Yeah, that's interesting. You guys want to call it? You want to call it? Is there any other product you want to talk about that you're excited about, John?
Anything you guys ever want to talk about, but I think crude's been the main thing in the news, and we're following, and it'll be interesting to see how quickly this thing ends.
So. I love the fact that we hit about the contango and the backwardation part, because I remember 10 years ago where, futures traders would be like, that USO thing, it's got decay. And then all of a sudden decay went away. And I guess intuitively, I know why that is. I don't look at crude as much as Bobby does, but that's really interesting to me that it's actually benefits from the backwardation part of it right now, which I love that. Tell them where they can follow you. Do you ever put out any research, or what's your website?
We do, USCFinvestments.com. And we can find everything on there. We've got some videos.
Which, by the way, I was on it today, and I really, really enjoyed it. I thought there was a lot of interesting stuff on it. I'd never been on it before. I was just prepping for this show, and I thought it was very, very cool. So thank you for putting that out. Yeah. Bobby, got any last words, or should I play us out?
No, I just appreciate John taking time with us.
He is John Love. He is the CEO of what's the company called? One more time.
USCF Investments.
USCF. I mean, we all know it. We all trade the products. I just didn't know that's what it was called. But which, by the way, did you come up yourself? Are you the brainchild of some of these ETFs?
Some of the newer ones, but not all of them. The original ones was our founder. So can't claim credit for USO or anything like that.
On our show, you can take credit for anything you want. We take credit. We'll take credit for launching USO in about 5 minutes, right?
Well, the ones you like are mine, and the ones
exactly. Okay, good. That's the spirit. Thank you guys for joining us on The Trader's Edge. I'm Jim Iuorio. That's Bobby Iaccino, and that is John Love. Thank you guys very, very much.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.